Hello and good evening, everybody. Welcome to the session tonight. I'm just muting everyone there. A few more still coming through from the waiting room. Well, what an extraordinary time it is in human history. Hey, just absolutely bizarre, isn't it? So, and some familiar faces we're delighted to have with us. Thanks, Peter Daly and Rob McCann, welcome. And John Gowing's here as well. Peter Gestos as well. Lovely to see you all. Marissa and Peter McDonald, lovely to have you with us as well. So many familiar faces, that's terrific. Thank you so much for coming out tonight, or for some of you for staying in tonight, no doubt. For us in Melbourne in lockdown, it was really not very inconvenient at all to, to have a webinar tonight. John Coyle, nice to see you, mate. Okay, and Reg is coming through. So Emily is our, in the background, co-hosting, making sure that we get going. Just for those who may not be familiar, I'm going to pop a chat message in the chat box. Still plenty of people coming through, which is wonderful. So Emily, you can keep an eye on that. Flooding through, that's lovely. So going to the chat box now, just in case people are not too familiar with Zoom, which by now is probably not too many people, but test chat message is being sent to everybody in just a second, everyone in the meeting. There you go. Have a look now and see if you've got in your notification settings a test chat message. Thank you, Sanjeev. Drew, excellent. Mike, fantastic. G'day, Peter and Marissa. Lovely to have you with us. Yeah, so Grant, you've got that there. Terrific. John as well. Paraj, lovely. So the idea is if you've got an important question, we would really encourage you to ask those questions on the fly as they pop into your head. Chances are with David and Peter and myself, if we think we're likely to answer that question already in the schedule, we will. We might not necessarily acknowledge at that moment your question if we already know it's in the agenda, but I'll certainly raise those ones, and so will the team, our panel, if we feel that it's a curly one that perhaps we haven't thought through and is not in the Q&A. We do have a live Q&A at the end as well. So we'll make sure there's plenty of time for those specific questions that come up at the end as well. And for those of you that are really looking for some direct contact, interestingly, Peter and David, we didn't get onto this topic before we started tonight, but only this afternoon I received an email from somebody who may not be able to attend tonight, already looking for some financial advice, and with 1.3 million in cash in the bank, you know, looking for some strategies around pension, and wants to buy a nice car as well. So there you go. So I'll make sure that we get all of those follow-up activities scheduled. Emily's our project manager for all of that as well. So please welcome Emily Hinz in the background there. Emily, you might just want to wave and say hello and unmute yourself. I'll just...
Hi, everyone.
There you go. Sorry, what have we done there? Give me a second, Emily. Try that again.
Hi, welcome everyone.
Yeah, thank you. So Emily's part of our team at Best Practice. And g'day, Ben. Thanks for joining us, Diana. Lovely to see you all. G'day, Jeffrey. So plenty of people still flooding through. So we're going to make a start. Just going to share my screen and go through a couple of just housekeeping items to make sure that's clear. I'm fortunate. I've got Peter on my left and David on my right on the Zoom wall of people attending tonight, which is lovely. So that's not too confusing for us, gentlemen. That's terrific. From where we sit, our special experts tonight, Peter and David as well, grateful to have you with us. Really interesting topic, isn't it? Retirement planning in a post-COVID environment. Goodness gracious. A big shout out to the nationally recognised Financial Link Group, over 150 financial advisors right across Australia. A group that we are synonymously committed to now at the Best Practice Business School, because they're really helping with that fully integrated one-stop shop with accountants, financial advisors, mortgage brokers, and so forth. So congratulations, Financial Link Group, for achieving that status with ourselves across Australia. And we really appreciate your support and the expertise that you continue to bring to events like this. So without further ado, just some quick housekeeping for you. This is your session, okay? And it's recorded for your convenience. So post-session, everyone that wants a copy of this recording, it will be available by midday tomorrow. So just keep that in mind. Emily is your go-to person for all communication. And Emily, should we, in fact, just from the start, drop either team@bpgrp or your preferred email address for everyone's benefit. That'd be wonderful, Emily. Thank you. If you put that in the chat box right now, there'll be not too much conflict and people will be able to find that. Okay. Thanks, Emily. It's already there now. There it is. Emily at bpgrp.com.au. Thanks, Emily. Great stuff. All right. So with the microphones, if you do not mind, we'll keep them off during the main session. We'll have Peter and David unmuted, and of course, they'll be commenting all the way through. We'll contribute during that main session. There'll be 10 minutes of Q&A at the end. And if for some reason your question is somehow overlooked, we will make sure that that question is fast tracked. We will be building a Q&A panel of all of your questions from tonight's event, because we actually record the chat box as well. So no question will be missed within 24 to 48 hours. That's our assurance to you. Okay. Fantastic. Please do use that chat feature as we go. You should all have found that now. There should be some chat notifications, and do contribute when you feel it's relevant. Don't doubt yourself. If you've got a question on your mind, chances are most of the audience have got the same question as well. Okay. Now we do, and please apologize, accept our apology for ticking all the boxes, but as you know, financial advice is a very important and a very serious matter. So the general advice warning here for everyone: the information contained tonight in this presentation is general information only. It's not specific, and it's not intended to be viewed as legal or taxation or financial advice. The Financial Link Group and its representatives have not taken into consideration any of your or any individual personal circumstances, financial needs or objectives in the development of this presentation or material. So if any persons are intending to use or act upon this information contained tonight in this presentation, consideration should be given to the appropriateness of the general information in light of their own objectives, your own particular financial circumstances and situations and needs before you act upon the information. Obviously, we've got an online instant access point for you tonight. We've got a link we'll share later on. And persons acting on the information covered or contained in this presentation should seek their own independent professional advice on the application of these matters to their own individual circumstances. In relation to any financial product or class of financial product mentioned tonight in the presentation, a copy of the suitable product disclosure statement should be obtained, and we can access that and provide that if you need that. Before any decision is made, that's an important thing. Okay, thank you for sitting through that. I do apologise, but it's very important. Welcome, Peter Chan from Queensland, David Shostrom from Adelaide. Delighted to have you with us, and yours truly. So here's our agenda. Can and when you afford to retire? What's the ideal amount to retire on? Will your investments recover in time for retirement from post-COVID-19 downturn? Will your assets provide you with financial freedom? How important is creating wealth from an ethical point of view? There's a new topic that you may have heard about, going green with your investments or being ethical. And what are the stresses out there that affect retirees, and are they changing now? And what are the current ones? Some interesting commentary from our panel tonight. The tools to properly plan your retirement in this environment. Understanding the toolkit is always important, isn't it? Okay, so Peter and David, I will bring us back to the panel session here. Make sure you're unmuted, and we're going to kick off with the hot topic of, can you afford to retire? Okay, so we understand everyone's different. Peter, what stands out to you in this current environment when we ask the question, can you afford to retire?
Yes, thank you, John. Good evening, everyone. Affordability, I guess, is really based on an individual perception of what is required financially. Everyone is extremely different in terms of their wants, needs, desires when it comes to funding their retirement. And to a large extent, I think the lack of understanding of what funding is in fact required in retirement is probably a big conversation point, John.
Yeah, absolutely. David, what stands out to you with this opening question? Can you afford to retire?
Yeah, I think, John, and thanks for the opportunity. Nice to be here. I think in addition to what Peter said, the need to take into account what are current assets that people currently hold is obviously a critical issue. And certainly, as Peter said, the sort of lifestyle that they do, that a person desires and what that's going to cost is all part of the equation that we need to weigh up as part of the planning process. And some of those big expenses that people may have when they retire, which could be a bit different than when they were working, such as, they might have to upgrade the home or buy a new vehicle, and of course holidays are an issue as well. They all need to be factored into that the equation to really answer that question effectively.
Yeah. And of course, the standard of living is such a variable, isn't it, in today's economic climate as well?
That's right.
Fairly high level of standard of living in terms of expectation in this wonderful country, that's for sure, John.
And I think we're actually going to get into that a little more in a moment, aren't we? So, all right. And so the next key question, of course, is what does the ideal amount look like today to retire upon? And we're talking about variables again, lifestyle expectations and so forth. Where's the starting point? Where's the starting number, do you think?
I guess zero by default.
Yeah, I mean, something that we've used as a baseline has been the old adage of $2 million unsecured, no debt, with fully franked dividends, income producing dividends, and whether that's rental property unsecured, without funding to retire, or whether it's fully franked shares or so forth, it should be producing around 100,000 a year. What does the market look like in the future for our investors and retirees?
Yeah, once again, John, look, I think it's there are many factors there that are involved, and we need to sort of do some sort of modelling on that. But what we do typically find also is that what you might think is a reasonable amount of income to retire on may not be what you find when you actually retire. So people do or will establish some spending patterns in a different environment when they are retired, and then we'll, I guess, then sort of develop a better understanding of what sort of income they do need. So there is a need to be a little bit flexible there also, to take that new, I guess, that major change in life stage into account.
Yeah, and as one of our other advice experts, I'll come to you, Peter, in a moment. John McAuliffe, another advice expert on the medical expenses, are quite surprising, which we're going to come back to in a moment. A really unexpected and unconsidered recurring cost, which will come into more detail a bit later on. Sorry, Peter.
Yeah, no, you're quite right, John, and I agree also, David, that modelling is probably one of the greatest opportunities we have of understanding, the expenditure, costs, etc., in that particular phase. In fact, any phase, it doesn't necessarily need to be retirement. It can certainly be in the accumulation phase up until retirement. And then that transition, perhaps just prior to retirement and then post. I can't, I guess, emphasise that the cash flow modelling and forecasting benefit of sitting with an advisor and sort of going through with that. Everyone is very different, as we alluded to earlier, and obtaining those expenses and those costs are absolutely fundamental in understanding what provisions need to be provided at that time. So
Yeah, thanks, guys. And when you talk about modelling, the purpose of modelling and what are the benefits?
all right, I'll go first, David. Yeah, look, what is modelling? Great question. So it's the opportunity of using software to take into account, I guess, just inflows and outflows in terms of cash flow, and the opportunity to incorporate, any perceived future expenses associated with retirement in particular, if that's what we're dealing with today on this webinar, and understanding what that looks like in advance, which enables us then the opportunity to consider, based on the information being produced today until said retirement date, whatever that is for whomever, and, retrofit appropriate strategies that are safe, that are accepted by the client in order to achieve that end goal. The other benefit also is it will demonstrate and point out, if there is any retirement shortfall in terms of funding. And again, we're able to then start considering what potential strategies are appropriate to either, lessen that shortfall or eliminate it entirely.
Yeah, and so modelling is a bit like scenario planning, David.
That's right, John. And I guess the other component we'd look at is you typically be looking at would be the impact on a person's assets, because in retirement, you may be in a position where you're drawing down some of those savings to fund a lifestyle, and the person needs to be aware of what those asset levels are as we progress. Also, so that's, I guess, the other component and value of doing that modelling process.
Yeah,
really a balance sheet situation.
Absolutely. And what about this clearer picture once you retire? I mean, is it predictable spending patterns once people retire, or is it something that really does benefit from modelling to actually help the client to start thinking through what changes might be fundamental to their spending habits and their living behaviour patterns too, dare I say?
Yeah. Well, I certainly think it's something that needs to be, particularly in the first period of retirement, needs to be monitored a little more closely. And if there's a significant deviation from what we may have originally expected, the next question is, what is the long-term impact of changing perhaps a higher or lower level of spending? So that's something that we can incorporate into the modelling as well.
Yeah, and interesting the trends too, isn't it? The ideal amount to retire on. The very well-known commentator from KPMG, I think Bernard Salt, spoke at a Master Builders event not that long ago when we were allowed to have public events in Victoria, and spoke about the fact that he was predicting that the ageing population would be hanging on to the matrimonial home or staying in the family home and renovating and looking to create that style of security and comfort more likely than necessarily always downsizing or going to an aged care facility until perhaps a bit later in life if their health is sustained. So are some of those challenges or decisions going to also impact on the modelling as well?
That's right. And you're right there, John. Some people may choose to stay in the family home for as long as I possibly can and engage some services to enable them to do that rather than go to an aged care facility at an earlier date. And of course, the decision to do those things has a big impact on how long savings last.
Yeah, absolutely. Thanks, David. And Peter, what about this hot topic of what the asset base is looking like in this current environment and post this current environment? It's the $1 million question, isn't it? What it's going to look like. Do you mind just talking us through your take on these 4 tips that we have put together for our audience tonight?
I'm going to jump on that one, am I, John?
Yes, please, mate.
All right. Yeah, look, I think with any investment opportunity, there's the outcome of gains, as there is also the outcome of loss. And it's a yin and yang. It comes as a parcel, if you like. You can't have one without the other, unless it's a short-term speculation call. Obviously, that's a lot more volatile than not. But if we're just talking safe investing over a specific timeline, it is about understanding that during that 7-year, 9-year investment period or time horizon, that we will, experience some gains and we will experience some losses. In my opinion, it's really about aligning that end result over that period of time with the client's end goals. So we're being very specific about what the outcome financially is, what that looks like, what's required, and then we're using multiple strategies overlaid with, over time, again, investment gains and investment losses. And it's a matter of, I think, diversifying your portfolios to ensure you've got the best opportunity of success or achieving that outcome. So, point 2, time for a health check. I think every day is a great time and a great opportunity for a health check. I think it's important for you to know your numbers, to understand your outcomes. And, whilst you're in your accumulation phase, your income earning phase, that's the best opportunity or time, if you like, to really prepare financially for that retirement goal. And understanding the history and behaviour and market conditions, what we're experiencing currently and what we have experienced certainly over the last couple of months is not an anomaly, as perhaps the media would like you to think or believe. It's been going on since the dawn of time. Market corrections are inevitable. They're absolutely a part of the investment cycle, and it's a matter of understanding what kind of losses could occur, and in the event that those losses are realised, more importantly, then, as David mentioned earlier, what does that really mean in terms of your end goal? What now do we need to consider as a personal strategy correction to ensure you stay on track and you achieve that end goal in retirement? So flexibility is absolutely the key here, and I think diversification of portfolios has a lot to do with that.
Yeah, and David, thanks, Peter. With the panel getting together this morning as well, reviewing our content, we were talking about this, the market corrections that are historical, Peter, that you just mentioned. And David, how important is this for a retail investor, your mums and dads at home, you're planning retirement? I mean, there's such anxiety around coronavirus, obviously, but what Peter said was a really interesting point, isn't it? That market corrections are in fact a fact of financial life, aren't they? They've been here for as long as we can go back and look at the data. David, what's your take on that?
That's right, John. And I guess when you think about it, we're going to have some significant market if a person's going to be retired for a 25 to 30 year period potentially, or perhaps even longer, they're going to experience many of the sort of corrections that we've seen over that period of time. So it is something that you need to understand and accept. However, there are strategies, as Peter said, that we can use to sort of, mitigate the impact sometimes of some of those corrections as well. And it's really important that that a person understands what their true sort of tolerance to those corrections are, and what they're comfortable in accepting. And it is a trade-off. So also sometimes if say a low level of risk is what a person is prepared to accept, that's what they're just comfortable with, there may be a trade-off sometimes in the amount of income that they can generate in retirement as well, and can impact their subsequent long-term living standards. So there's a lot of discussion that needs to be sort of had around that, but it is a matter of being, I think, as Peter said, being flexible, and also making some adjustments as market conditions change. That may mean sometimes if there has been a correction, it might mean reducing spending a little bit for a period until those investments can recover. So yeah, flexibility is a key.
Yeah, and just on that, if is too good to be true, and you're thinking that for a prolonged period of time, what does that tell you about a potential market correction?
I guess typically it's more likely to happen.
Yeah, you know,
It's imminent.
I was going to say the devil's in the detail, was it not?
yeah, and look, I do remember quite specifically a very successful fellow cashing out of all of his shares, very close to the edge of the GFC, right? And saying to me that he pretty much put most of it into cash, and he was criticised by being aggressive and jumping back into the market when CBA shares had hit an all-time low, not long after. And in that particular cycle, I should say, all-time low, right? And when he was asked why was he getting back in so aggressively so quickly, and he was completely satisfied with the market correction, and it was as simple as that. He wasn't distracted with anything else, and he looked at it, dare I say, in a compartmentalized way. It was like a modular topic. It wasn't relevant to his company that was trading poorly and struggling financially with its own cash flow. It was a totally separate opportunity. Is that something that's a bit more difficult for a less risk or a more risk-averse investor?
Yeah, I think to some extent you're probably right there, John. It is, but again, there are ways that people can still incorporate some risk into their portfolio, such that they can still generate a sort of a consistent, sustainable sort of level of income, and perhaps not to be adversely affected if there is a market correction. They certainly will be. You can't avoid it if you do have some exposure to investments that have some risk, but we know that they tend to generate perhaps a bigger return, a larger return over time. But as Peter said, diversification is the key to try and help you sort of mitigate some of that risk further.
And so, Peter, diversification creates a bit of balance and a bit of risk mitigation, but also an opportunity perhaps to just think a bit differently and also have an aggressive element for those who would have preferred that otherwise if it wasn't for just how spooked they might be in the market, right?
Correct, John. And one important point I think it's worth sort of notating is the strategies become more challenging, if you like, or more volatile from a risk perspective, exposure to risk, exposure to loss, on the basis that you're approaching retirement tomorrow, as opposed to perhaps in 5 years' time, in 10 years' time, in 15 years' time. So what I mean by that more specifically is, the sooner you consider, taking part in this discussion and really mapping out what it is that's required in order for you to achieve your financial end game, the better. The less risk you need to take, you have to take, and I think that's worth considering for sure.
Yeah, absolutely. Thanks, guys. And moving along, will a person's assets, will your assets provide you financial freedom? Let's talk about a couple of different scenarios here. Firstly, what are these key points all about, and why are they important, irrespective of whether somebody's just starting a bit late on their retirement plan, with a few years down the runway to get organised, or if someone's got a little bit more time. What's this first point all about, guys? Peter, are you happy to kick us off with understanding compounding growth?
Sure. Look, I guess at the end of the day, it's, your ROI, your return on investment, the ability to leverage using, other people's money, someone else's money, the bank's money specifically. So an example would be, going to the bank and borrowing X amount of dollars for the sole purpose of investing, whereby the money you physically put in might only represent 5-10% of the full investment level. And that just, I guess, at the end of the day, reduces your risk, your exposure to loss. Should that money be lost at the end of the day, kind of wasn't your money to start with. So there are some benefits in I guess, leveraging and considering, borrowing opportunities. And the compounding growth is quite simply the appreciation of any asset over a period of time, and exponentially that can occur when you're adding things like interest rates and capital appreciation and other compounding scenarios to the equation. And again, I think with a diversified approach to your portfolio really does enable you to leverage. Again, the earlier you start the equation, I think the better for sure, definitely.
Yeah. Thanks, Peter. And David, why is knowing the risk tolerance profile as an individual, why should I know my profile? What's important in doing so?
Yeah, John, I think one of the first, I guess what it leads to is, first of all, I guess the individual needs to understand, how they're going to react to an adverse situation. I think that's important, particularly for retirees, so that they can sleep well at night. Given that when you're retired, you often don't have the ability to go back and earn any lost capital. So important that people understand that, and then can perhaps relate that to how their investment portfolio is positioned as well. And of course, the different types of assets, to what extent they have a mix of shares, property, bonds, cash, and so forth. So I think if you understand that the amount of risk that you could realistically tolerate in adverse situations, you can then it helps you to fashion the correct mix of assets that you'd be comfortable with. And I guess that in turn also then allows us to assess what sort of return such a portfolio would generate. And I've certainly seen many of occasions where if that result return isn't what's required to sort of generate the desired level of income, then adjustments may need to be made. It might mean that we need to draw less or draw from savings at a lower rate, or sometimes perhaps accept a bit more risk in the portfolio, if the person, of course, is comfortable with that, to achieve a higher return so that their lifestyle living standard can also be improved as well. And obviously there are different strategies we can use to do that, but certainly the mix of assets, is shares versus property, bonds, and cash is part of that. So that asset allocation, if you like, as we call it, is a key decision that needs to be made for retirees. And I think, as Peter also mentioned before, the impact of losses in the years just leading up to retirement and in the early years when retired has the biggest impact on the longevity of one's capital as well. So we need to consider that, understand that fact, and take that into account when we're investing money.
Yeah, and thanks, David and Peter. And a timely question from Ryan. So thanks, Ryan, for speaking up. Appreciate that. Are we forced to take more risk given cash returns are so low currently? Well, I'll give you guys a moment to think about that. Before we do, there's another elephant in the room as a topic, isn't there, around not only Ryan's question, but the key points on the screen coming, if we go back to those, and that is the cost of money today. Absolutely. And the ability to leverage that, Peter, for compounding growth. Yep. Which goes back to this particular question in some ways, doesn't it?
Absolutely, and look, the cost of money to Australia, if we consider that on the global front, it's been creeping for quite some time, almost to the point globally where Australia is not attractive to even lend money to, which obviously creates some challenges with regards to accessing cash on the domestic front. So, absolutely right, John. Absolutely right.
Yeah, and yet what we're also seeing is mortgages and interest rates on the traditional home loan being at an all-time low. So equity unutilised in the matrimonial home is a sleeping giant of an opportunity in this market. So what about that question? So let's go back to the question, giving that in mind, and so we've got the question again, guys, is from Ryan. Are we forced to take more risk given cash returns are so low currently?
I'll let you go first, David, but I've got a definite response for sure.
Yeah, sure. I think, Ryan, that's what you're saying has certainly been happening. That investors, including retirees, have, I guess, seen a need to take a lot more risk, to achieve some, hopefully some better returns. And in actual fact, sometimes have even turned to extremely risky investments that may be growing but not generating any profit. But because they are growing their sort of revenue, if you like, they seem to be a safer bet than some of the more traditional investments that can be found that may be a lot more boring. They're not growing their sort of their revenue anywhere near as quickly, but still produce a reasonable level of income. So there are certainly investments that, I guess, focus more on the income side of things, be it franked dividends and so forth, that would be more, I guess, relevant to a retiree. Of course, it's the key thing there is that if you've got to be very careful that if you're targeting investments that have a good level of income, what sort of risk is associated with some of those, because in some cases it probably isn't acceptable. So there's a fair amount of analysis that needs to go into that, but it certainly is possible still to generate a reasonable level of income, I think, without sort of excessive risk. But there are a lot of traps as well.
Yeah, thanks, David. Peter?
Yeah, I agree, David, and I think one of the key differentiators here is, are you in retirement or are you pre-retirement? And if you're pre-retirement, how far from retirement are you? And I think that question certainly for me resonates on that level. I think it's very much about where you are at any given time. And if I take the view pre-retirement, I'm not of the opinion that, the current climate and perhaps switching your assets across into cash or holding a higher percentage of cash in your portfolio is necessarily detrimental to your outcome. I don't think, as a result, Ryan, that you need to consider taking on additional risk again if you're pre-retirement. Post-retirement, very different story, and I think this is why I sort of said to David, yeah, I have a response to that, and it'd be interesting hearing yours, and thank you. But I think post-retirement, it's a very different equation. Potentially, you could be forced into a position whereby you have to consider the possibility of taking on more risk to maintain or achieve that same desired financial outcome. So very specific question, and it's the response will be very specific also in that it's absolutely dependent upon where you are and what's going on with you.
Yeah. Yeah. So how are you already in? Are you not? And how far away are you? So these are fundamental points of consideration, aren't they?
Yeah, very, very much so. And I guess I'd probably go on a generic sort of statement that ideally, if you can, avoid taking on additional exposure to risk and still achieve perhaps the outcome over an extended period of time that you're looking for, then I would consider why is this not the best strategy for you.
Yeah. Thank you. Thanks, guys. Okay. Next key question is, in fact, how important is creating wealth ethically or ethical investments? And this is quite a new category, and we're not talking pie in the sky or bizarre investments that may or may not have a return, are we? We're actually talking about typically a trend that we're seeing in younger investors looking for ethical investments. Peter, what is this all about?
Yeah, it's thanks, John. Look, I guess another way of perhaps presenting this is sort of socially responsible investing. For the first time, I guess ever, we have a third vehicle in terms of an investment that, as advisors, we can bring to market and share. And what that has brought to market, and you're right again, John, it tends to be that younger demographic today. And when I say younger, look, 40, 45 and younger, whereby the technology exists on the platforms, the investment platforms, to, I guess, take out those those investments or those underlying assets, those companies that you personally have an aversion to. Example of that could be, I don't know, adult entertainment, alcoholic beverages, oil and gas, these industry sectors that you have very strong values around with regards to not wanting to contribute or investing money in those companies. And for the first time ever, we're able to, what's referred to as negative screening, we're able to actually screen those companies, those entities out through deep analysis and research of each individual company that comprises the construction of that particular investment portfolio, and simply edit it, just delete it. And, you know, that's something, you know, in the past, we just haven't been able to offer really with regards to any consistencies. And there's some sort of 12 to 15 industry sectors now, so it's growing, that, you know, you can now consider and weigh in, I guess, in terms of your personal values from an investment perspective on where you would like to see your money being placed, and where, more importantly, you would like your money not to be invested. So it's a massive opportunity for people to really invest in what they believe and feel they want to invest in. Yeah,
fantastic. So we're talking about a greater sense of empowerment and personalised investing, which is not necessarily moving away from a premium return, so to speak, but it's actually being able to deselect contradictory investment models that your own personal value set is not comfortable with.
Yeah, actually, that's a very good point, John. I'll just reiterate that. Just because we are looking at screening particular entities because they're involved in a particular industry sector that you may not feel particularly comfortable with, doesn't mean that that is to the detriment of the portfolio return. Absolutely not. Yeah.
Yeah, thank you. David, are you seeing you know, people in retirement looking at ethical investments? Is it a topic that comes up?
I think that certainly the interest is growing, John. And one of the interesting areas that I've come across in discussion with clients recently are particular investments that tend to focus on outcomes. So some clients are coming in and saying, well, we're interested in investments that are, or if you like, businesses or whatever, that improve the living standard of people in third world countries or something like that, or education standards of communities. And so, and there are investments that will that do focus on, you know, such areas. So I guess in the broad area of ethical investing, there are all some of those specific subsets and that people are becoming more and more interested in, and we, you know, it is possible to incorporate those into a portfolio as well.
Yeah, so that traditional vanilla, this is your portfolio, those days are gone, is what you're both saying, isn't it?
Absolutely.
Yeah.
It's great to see that the platforms have, I guess, matured to the point where, you know, clients can really get involved, they can really make those decisions, and it's not going to affect their end game necessarily.
Yeah, well done. Thank you. Okay, what are the stresses that affect retirees? What are the big impacts that cause stress, cause anxiety, and actually, dare I say, also have an impact on quality of life as well? Yeah,
I'll throw this one in. You know, do I have enough? I think that's a big one. You know, so many people I speak with and have done over the years, the anguish is the mental anguish, the physical stress that comes with just not knowing. As simple as that. So I think to have some clarity and understanding around that in the first instance takes that away. And I think that's a big thing, just personal comfort.
Yeah, and I guess that goes back to what you were both saying earlier about modelling as well, and how important that scenario modelling is, and to understand that and the impact of those elements. Yeah,
absolutely.
That's right.
Yeah, David.
And I think that I guess that thought, that inability to return to work and replace any money that may have been spent does cause a bit of stress, anxiety amongst particularly the retirement community. So that's that's certainly an issue. And as Peter said, I guess that the fact that we don't know how the future is going to unfold is another stress point. But I guess I guess a lot of that uncertainty tends to be in that shorter term. I think we can perhaps talk a little bit more confidently about some of the longer term, I guess, issues such as investment returns and things like that, how they tend to play out over long periods of time. So yes, and it was always a balancing act.
Well, one of the other things I'd add to that too, David, is something that I guess come to realise in recent times is the perception of possibly how much we actually need is not necessarily correct. I.e., we don't necessarily need as much as we think we actually need. And I know that may sound like a kind of an interesting, controversial sort of point, but it's something I found over the years that, people's perception of, they might need 3 million, 5 million, whatever it may be. And the reality is when we break it down and we get into that financial cash flow modelling, we look at their expenses, the sorts of things they want to do in retirement, an overseas trip a year, whatever it may be. The required money for that is, in a lot of instances, a lot less than they ever imagined. So I think there's a misconception about how much you do in fact need, and that has a direct weight and bearing and pressure as you're in your accumulation phase, as you're working for 10, 20, 30 years to kind of achieve this magic big number at the end. It's not necessarily so in my experience.
Yeah.
And I think also the realisation that we've got a fairly reasonable social security system also, which really sort of acts as a bit of a backstop in that if people are drawing down some of their own savings over time, they may get to a point where their assets and income are at a level such that an age pension kicks in and then replaces some of that income. So that scenario can also work very well, and it's something we need to take into account when looking at the affordability of sort of funding a lifestyle over a full lifespan.
Yeah, and one that I know John McAuliffe, another one of our advisors, is very passionate about is the often unexpected or unanticipated recurring cost of medical expenses, which is actually surprisingly significant across the board, which is something that we don't, when we're fit and healthy and, heading towards retirement, we don't consider those things, right?
Yeah, that's right.
Yeah, we're pretty invincible here in Australia.
Yeah. Absolutely. Okay. Let's talk about the tools now, gentlemen, to properly...
So just one point there, John, too, the first question there on the last slide.
Yep.
Longevity shortfall, it's a term that, quite simply refers to the gap whereby we're living a lot longer, and in some instances, it's not out of the question to consider cash flow financial modelling to 90, age 100. And, certainly for myself, and I imagine you also, David, going back in time, life expectancy might be 70, 80. We've got another 20 years in there. And when you start to really consider what sort of costs or expenses are associated with that extra decade or two, again, it's significant. So kind of comes back to the earlier you start, understanding what your end goal is, and you overlay the fact you're going to live longer, it gives you, I think, a better opportunity of really safely gearing up to achieve that end goal financially. Yeah.
I think also the impact of inflation has been mentioned, and that's another key issue. And I guess that's one of the arguments why an investor would always consider including some assets that can compound, where the capital can grow also to counter that inflation impact. But again, that's a discussion about what sort of risk you're prepared to take on, what are you comfortable with, and understanding what impact that'll have, whatever your decision.
Yes, agreed. And again, if you consider the aspect of diversification, in my opinion, you'd want portfolios that were income producing, but also were compound or capital appreciation producing as well. And I think it's that overlay that gives you, the best opportunity of achieving those goals safely.
Yeah, I also just referring to the last couple of points also with regard to accommodation. That's something that often many people contemplating retirement may not have thought about, how long they're going to stay in the family home, where they're going to perhaps qualify for some funding for home care packages so that they can stay in the family home and bring in some people to do some of the work that they're no longer able to do. In some cases, they may perhaps not get funding and might fund that out of their own savings. So that's something that we might need to account for when we're sort of doing our modelling. Or of course, if it comes a time when a person isn't able to stay at home and they may need to look at aged care accommodation, just how that's going to work, how it's going to be funded, and if there's a spouse, whether they're staying in the family home, how all that works. And I guess the other thing that I think that's very certainly paramount in people's minds also often is whether they will pass a legacy, or if you like it, in their estate to their family as well. So that's also quite a priority. And I guess that's when if we do some of that asset modelling, we can get a little bit of an idea over that period of time as to whether or how much money may be left in the estate for the family at the end. And it is an estimate. You can't be too accurate over periods of 30 years or something like that, but it gives us at least a bit of an idea of appreciation of how things might play out, what might be possible.
And if leaving a legacy is important to you, and I haven't come across anyone yet that says they, given the opportunity financially to do so, that they wouldn't like to, the tax implications of how that's distributed in the structure is critical. It's huge. It can be a small fortune. I really do mean that. Hundreds of thousands of dollars can be simply taken in tax concessions. So a big conversation around legacy for sure.
And even the nature of the asset class as well, correct? In terms of the types of assets, the type of income they're producing, and the timing of that pre and post entering retirement. Important implications, aren't they?
Absolutely. The age of the beneficiaries as well.
Yeah.
I think we need to take a pretty comprehensive view of an individual situation as well. And I guess that's where issues we don't really, I guess, deal with directly ourselves, but where we need to sort of, I guess, educate people about wills and estates and the importance of some of that estate planning, and refer to the appropriate people also who have the skills to draft those documents and do it in a way that money will pass to the right people at the right time in the most sort of tax effective way that it can be done.
Yeah, absolutely, David.
Thanks, guys. And looking at the tools now, the tools for properly planning the retirement. And I guess you were, Peter, only a moment ago, talking about the structuring and how important that is, and David, estate planning, and the integration of income and tax management with superannuation as well. Why are these things so important, and dare I say, is it fair to say they're all interrelated as well?
Go on, Dave.
Yeah, they are interrelated, John. I think one of the things that stands out as a first point there, I guess the first critical element is the time commitment and involvement. Because I think that whilst a client can delegate some of the, I guess, the strategy formulation and so forth to us, it's a collaborative process, and it really demands, I think if a person's going to be successful and achieve their goals, they often need to be prepared to commit time to learn and understand and be involved in the process. And that's really an ideal client, if you like. That's really what any advisor would love from a client, as far as that goes. Yeah, Peter.
Yeah, agreed, David. And I think the other thing also is making money's fun, guys, like ladies as well. It is. It's an aphrodisiac. I enjoy it. I created some substantial sort of personal wealth, and it has its moments for sure, but it's fun, and I think that's one thing we need to probably just be mindful of. It doesn't need to be a heavy stressful, complicated relationship in any shape or form. I think, as advisors, if we can keep it relatively simple, obviously we've got legislative requirements we need to meet, but we can still have the dialogue and the opportunity to educate our clients. And that's something I'm massively involved in, is ensuring that our clients, understand what superannuation is, understand what platforms and portfolio investing is, and the construction of the portfolio. And I think it's interesting, and I think it's the opportunity of making it fun and interesting also for anyone else to get involved. I think the opportunity for you to take control of your investments and create your own wealth has never been easier. The online platforms now allow 24/7 access. The forums, the information sources, resources that you can access, I think answer a lot of information. So I can't help but think that those relationships with your advisor, your portfolio manager, are just so much easier to have in a fun, beneficial way, for sure.
Yeah, absolutely. Thank you. So key point there is that this can actually be fun. So despite the pandemic, despite all the other anxiety that the world is facing at the moment on the other health issues, you can still actually enjoy and get fairly motivated by your own personal retirement plan and getting proactive about that, right? That's the key point there.
Yeah, definitely. And I think that's what keeps the interest. If it's not fun, and we all remember at school that teacher that kind of kept you back for an extra half hour, and you never ever wanted to meet that teacher on the street walking home. So I think the reverse of that is the opportunity here, and it doesn't need to be a heavy web of investment strategies that are complicated and so complex that you actually don't understand where your money is or what it's doing.
Well done. And I think that that is such an important point, to remain positive with your financial intentions for yourself and your family and the legacy of your own, what your life's been all about. And of course, the downside, I grabbed this from the OECD report from November 2019, just this one key bullet point, pensions at a glance. I haven't loaded that up yet, but relative incomes of those aged over 65 to the total population are low at 72%, compared to the average of 87%, while poverty rates for the elderly, November last year, are very high in Australia at 23%, 10 percentage points above the average. So I guess conversely, if we're not getting on the front foot and we're not embracing the legitimate opportunity to plan for our retirement, 23% of Australia's retirees clearly didn't do that. That's for sure. In that regard, unless of course there was natural disaster and unexpected issues that they had to deal with. So it is a really important thing. Now, we've asked the two of you to come up with a bit of a consult as a complementary thing. So that's we'll come back to that in a moment. We do have one great question that came back in the chat box just a moment ago, and that was from Naresh. So, how long does compounding growth take? And I'm sure a glass half empty is going to say how long's a piece of string. But let's be quite practical about this. What can be achieved, given lending is so incredibly affordable right now, and banks are really looking for security to lend. So a little bit of home equity can create that and give it a bit of a leapfrog. What does compounding growth look like? How long does it take, Peter?
Yeah, interesting question, and you're quite right, John. I think it is about how long is a piece of string, but I think probably my response comes back to how long does it take? I would probably reframe and go, well, what is the financial objective that we're looking to achieve? And then we would consider where we are today and what the timeline or time horizon or frame looks like in order for you personally to achieve that goal. And then I think that starts to define the question more accurately. It's not necessarily about how long it takes to achieve that. It's what our end goal actually looks like and how long more appropriately will it take to achieve that. And then obviously the factors that David mentioned earlier and I spoke about with regards to, exposure to risk. Obviously, if your timeline to achieve, X amount of dollars is 3 years, the risk associated with whatever investment strategies we may recommend will be very, very different than if your time horizon is, a 10-year or 15-year stretch. So, probably for me, not so much about how long compounding growth takes, as opposed to, what's the outcome we're looking for and how long does that take, more specifically for you.
Yeah, thanks, Peter. David?
Yeah, I think it depends on also what specific sort of assets you're invested in. But what we do know is that the impact of the compounding tends to be greater further down the line as the years roll on, where you get sort of if potentially things going well, you can get some sort of exponential increase in value. At least that's happened in the past, and I guess there's no guarantee it's going to happen to that extent in the future. But there is, I guess, the potential there for some good results.
The other aspect, in addition to that, David, is the cost of the opportunity. So, where John mentioned earlier, the rates have never been more cost effective today in terms of leverage and borrowing. That has a massive impact as well on achieving your outcome in terms of your ROI, your return on your investment. If you're paying 2 times, 3 times for that dollar, if you like, or borrowing, leveraging, then the compound growth by default on a timeline is going to take significantly longer to achieve whatever number it is you're looking to achieve. So I think that's an important determining factor as well.
Yes.
Yeah, well done. Okay, so let's talk about what's a logical step from here. And I heard some really great commentary about modelling and understanding those scenarios, guys. A starting point, though, by the way, that's the reference I made a moment ago, just to bring that up. Okay, and that's what that's all about. So let's talk about what we've asked you to make available, and that is just a private consult, which has got no bells, whistles, or steak knives associated with it. It's just a private, where are they at and what should they consider? So if people interested in taking that up can take that up directly with Peter or David, and we're happy to arrange that. And we'll show you in the moment. We've got an online form, and I'm just about to get a link to that I'll be able to share with you in the chat box in just a moment. So just give us a moment. So let's talk about what's the real concept here in that 20 or 30 minutes. What's the objective, Peter, in that 20 or 30 minutes initially?
Quite simply to understand the client's objective, to allow them the opportunity to discuss what that objective may look like, given the fact that most clients don't know what the objective yet is. That's the benefit, I think. Yeah.
David, how does this help, not just you, but how does this help the client in getting, dare I say, a bit organised?
I think I think one of the other purposes also is to really clarify what the key issues are, or what are the things that require some more attention to achieve a better result, and given what their goals are. So I think from both the advisor and the client's perspective, it's certainly the light can go on as to what are the key issues, and perhaps what steps do we need to start taking to address those. So that's, I guess, the purpose I'd see of the financial health check.
Yeah, well done. So we will now just bring it up on screen. That's a complimentary registration for that. Absolutely no charge. It's just a thing that we've been able to convince these guys to give you a hand with, which is lovely. Well, I'll share a link in the chat box in just a moment. So for those who want to get access to that opportunity straight away, it will come up in just a moment, but we are moving into Q&A. So we're going to, now the guys have very kindly said they'll stick around properly now for no doubt some important questions. So I'll share that. Thank you, Emily. You've already shared the form. That's wonderful. Great job there. So you can see the hyperlink there. in the chat box. Emily's pushed that out to everybody there, so you can just click on the link to just simply register if you'd like that complimentary session at no charge to you, thanks to the Financial Link Group. Well done. But it is Q&A time, so think about your most from the simplest and the most obvious to right through to some unique questions. Every question's a valuable question, and particularly when these guys are available to you firsthand right now. And I'll bring up a question that was emailed in. I think I mentioned in the opening remarks, didn't I, about somebody who was 63 years of age, dropped us an email, may not be attending tonight. I'll bring that one up as a starting point, and that might get the juices flowing for some of you. It's a great little scenario. So this is earlier this afternoon. Okay, and of course, the gentleman's name will not be mentioned, of course. So as of October 19, forced to retire, and has been fairly successful in investing in commercial property and had good income from some tenancies as well. And so we're in Q&A, so start thinking of your own questions, but here's a great scenario. So here we go. So at 63 years of age, 1.3 million in cash, sitting in the bank, earning those fabulous interest rates. Pardon my, anyway. And
we're not in negative returns at the moment.
Yeah, and now, has grown children. The children are married, okay, and so off this fellow's hands, and doesn't need the cash. Is more than happy to park away, say, $1 million, but and possibly reinvest that. What could be the options for that? And remembering 63 years of age and retired, and also and has recovered from. Remember what we spoke about, those unexpected health issues. Successfully recovered from the challenging cancer topic, and but would like to buy a nice car at this point in life, and that's absolutely reasonable. So, so therefore, suggesting he's got a little bit of money for a nice car and would like to park $1 million. What's the smart thing to do? Peter and then David.
I just felt like a gun was pointed at my head. David, how about you?
Well, I think this is definitely a conversation that just goes back to things we've discussed, and what are the, or perhaps trying to clarify what are the actual goals that the gentleman has, or what other goals does he have that he may not have perhaps expressed so far, and what sort of level of risk is he prepared to tolerate? Should there be adverse market conditions, which will definitely happen. There's no doubt about that at some stage. Whether that's something he's able to tolerate, whether that fits in with some of his plans. What sort of access does he need to the money? Does he want it to be liquid? Is he prepared to commit that for a period of time? So there's a number of issues there, and I guess what his personal preferences are. And we really need to establish what his level of understanding of investments also is. So I'd probably start with some of those sort of questions first, because there are just a myriad of possibilities that we could present to him. But it really depends on those issues. So it's really a collaborative process. We really need to, understand the investor extremely well, and I guess come up with a solution that they're very comfortable with, and something that they understand. They must, and that's a critical point too, I think, that they must understand the end recommendation and be comfortable with that.
And I think I agree, David. I think probably one of the biggest points to consider there is probably liquidity. Cash on hand. What does that look like? Until passing. And I can't help but think that this is where the cash flow forecasting and modelling really comes into its own, where you've got a set of quite complex circumstances around a particular client, whereby there's a myriad of different strategies you could consider moving forward. As David mentioned, absolutely client preference would be one, and then it'd be risk tolerance with regards to outcomes financially, overlaying investments and liquidity. So the modelling is an amazing tool that really allows us as advisors to take into account, all of those variables, those different scenarios, and play them out with reasonable certainty to hold discussions of outcomes, future outcomes. So I think it's a great modelling opportunity for sure.
And look, great question from Robert McCann. Thanks, Peter. Thanks, David. Retirees often don't want to worry about their investments. They want to have that, taken care of and on autopilot to some extent. Do you recommend something like lifetime annuities? And just in case that's not a familiar term to some of our viewers tonight, what are they and are they recommended?
If I could just start with that one, essentially a lifetime annuity involves the investor giving investing their money with an institution that promises to pay them a regular income at an agreed interval. It could be monthly, quarterly, half yearly, whatever, for the rest of the life. And that that income is guaranteed. There may be an indexation factor where the income increases each year as well. So I guess with a true lifetime annuity, what you're doing is you're actually passing the investor is actually passing the risk that they will live beyond their normal life expectancy to the provider of the annuity. So it's really a way of, I guess, hedging the risk that you may run out of money. And we particularly consider using a lifetime annuity to cover some of those, ensure that we've covered those basic core living expenses over the client's lifetime, and then they can supplement that with other types of investments that they can use for discretionary spending purposes. So it really, I guess, creates or provides income to cover core expenses is the way that we'd normally use that sort of product.
Thanks, Dave.
I think there's a certain amount of comfort around, knowing that there's a predetermined value annually, in terms of income. It's that absolute, understanding that no matter what happens moving forward, you're assured of this income stream. So,
yeah, thanks. Thank you, gentlemen. Other questions? Do we have any other questions? The Q&A, the panel is here. It's your opportunity to ask any specific questions, and certainly also the opportunity to get that form, and Emily will make sure we email that out to all the registrants as well. With a copy of the recording, we'll follow that as well tomorrow by midday tomorrow. Do you have a...
I've got a question, if I may.
Yeah.
I'm interested in, David sort of mentioned it earlier, and it's something that we recently got across, probably some 18 months, 2 years ago. I'd be very interested in understanding who of you has a will, and if you do have a will, when was the last time it was updated?
That's a great question, isn't it? And
really interested.
Let's do a simple Q&A poll here. That's ready. Yeah. In the chat box. Let's go. Everyone in the chat box, I'll go in there. Who has a will? Yes, no. And how recently updated, if you do have one, and if you know, it's a no. Okay.
And John, I'll share with you why I'm sort of quite interested in the feedback. We found over the last 18 months, 2 years since we moved into that space, and we're surprised as advisors, the clients we've had for many years didn't have a will. And I'll be honest, there was over 50%. And it was quite a concern as an advisor. And if you're not concerned, you should be concerned if you've got multiple assets. I don't know if anyone understands what actually happens if you unfortunately did pass away early or got an early promotion upstairs, what would actually happen to those assets? And unfortunately, it's not good.
Yeah, ward of the state's not recommended, right? But sadly, it's often an unknown for some people, right? It's just out of mind, out of sight. So,
Well done, Rob.
Yeah, thanks, Rob, for sharing.
Yeah.
And we're a couple of no's there as well, though. And look, I think the truth is we do have lots of financial advisors and accountants in the best practice network, of course, and many of you attending tonight. So we'd have reasonably high expectations of you, as you can imagine, and the painter's house being painted in that regard. But certainly it's a big issue for accountants and advisors, and I can share wholeheartedly with our non-accountants and advisors on tonight's session that that estate planning topic and integrated with retirement planning, it's quite a naive market profile out there that we really do need to raise the awareness of as a professional body, you know, and more education-based, awareness-based, topical, you know, content, whether that's through social media or emailing out, just simple awareness-based articles and so forth, just to jolt your clients and having them thinking about it, because 23% of us in retirement as of November last year living below the poverty line is a bit of a concern, beyond, you know, more than 1 in 5. So a great, here we go, Christopher. Okay. And by the way, Chris Durbin, so lovely to have you with us, a long-term BP family member or client. Can you please answer an SMSF question? If I die and both my children are also trustees of the SMSF, do the assets and the value of the share still have to be liquidated, or can they stay in the SMSF? Interesting question. If the children are clearly below retirement age, Chris, is you right? That's one of the things we know. And they're the trustees and you pass away. Does the fund need to be liquidated based upon a deceased estate, essentially, right? Or can the trustees maintain the continuance of those assets?
Well, the answer to that, John, with the self-managed super fund, where there's a death benefit, it actually needs to be paid out, and there's also some restrictions on whether it can be received as a lump sum or a sort of a regular pension, where it can be paid out of the fund as a regular pension, as to who can receive that. So depends on whether a person's a dependent or not. So I guess with the children, it depends on if they're trustees, they may well be members also, or perhaps not. We just don't have quite enough information there. But nevertheless, it's likely that it would need to be paid out, so it can't stay in the fund. And for that reason, that's why with self-managed super funds, liquidity planning is a very big issue. Because you can have a lot of self-managed super funds may have primarily a property and a bit of money in a bank account. Are there only 2 assets in the fund? But of course, if somebody dies and you need to pay out a benefit, it's pretty hard to pay out a benefit when your only asset pretty well is a property. You're going to have to sell that property in many of those cases to be able to pay out the benefit. So,
the perhaps other additive I'd contribute to that is it's something we haven't actually discussed this evening is you know, sort of asset protection, and I think that's a very part of investing as you're moving forward, particularly in, you know, accumulation phase, where you're perhaps exposing yourself to you know, a greater percentage of risk or loss. Not so much so when you're retired. Your debt levels generally tend to be lesser if zero, if not zero. The sorts of, you know, asset protection policies that can be worked in conjunction with this kind of structure will ensure that, you know, liquidation of assets may not necessarily have to occur. So again, very specific question, and the answer is very specific based on you know, the specifics of your particular structure in any given client. Yeah.
Well done. And question about dividends. So thanks, Robert, for sharing that question. So dividends have taken a bit of a hit, obviously, lately. and dividends from direct equities. What about going forward? What do either of you see as the future of direct equities at this point in time?
I think, like anything, it's cyclic. You know, you're not going to experience those gains continuously throughout the investment, you know, time horizon or timeline without experiencing some loss. Today, at the moment, we're realising those losses. Having said that, depending on what market sector you're involved in, we are seeing positive returns now in direct, I guess, comparison to the losses that have been experienced. It has turned. In terms of how that will play out moving forward, I guess that's anyone's guess to a large extent, but probability, one would think that it would strengthen day on day, year on year, and get back to those kind of forecasted returns that attracted us in the first instance to invest.
Yeah.
I think it is fairly likely that some companies will be holding back dividends for a little while because they'll need to they'll be keen to build up their own capital savings for a start. In the case of banks in particular as well, I think they've also been asked by the regulators to reduce their dividends for a period. It's just part of good practice managing their capital as far as that goes. But as Peter said, I'm sure that things are likely to return to normal in the future. Who knows? But that's probably fairly likely, given that companies like to reward their investors with dividends, and they are aware that a lot of retirees are very dependent on dividends as well. So, and Australia does have a pretty good level. Australian companies pay a pretty good level of dividends compared to what you might get in some other parts of the world also. And particularly with our franking credits is essentially a bit of extra, I guess, income on top.
Yeah, thanks, Dave.
We may see a slight lean towards, instead of cash dividends being offered, percentage interest in those businesses offered instead. So you may find it's not necessarily a cash consideration anymore, certainly in the short term, as David pointed out.
Yeah, and a question from Jen. Thank you, Jen, for this one. If you are planning to retire in 5 to 10 years' time, is there an ideal percentage between liquid versus growth assets? What should be aimed for?
Interesting question. I'm going to go with no. I think it's specific for anyone and everyone. That percentage sort of mix ultimately, you're right, you don't want all your money tied up in assets, and you can't afford to pop down the local and have a couple of ales on a Tuesday night or Friday if that's your thing. But I think it's sense and sensibility. It's a matter of just working through again. Modelling would be a great asset in the process. Understanding, what the expenditure looks like, what cash reserves are required on an annual basis, and then to sustain that in the longer term, what that looks like in terms of assets, appreciating assets. So I think it's a very specific question. No percentage rule that I'm aware of that I would feel comfortable with suggesting.
So difficult to make a blanket opinion. Thanks, Peter. David, would you agree with that without really understanding the risk tolerance and the risk profile of the client? Yeah.
That's I'd certainly agree with that, John. And I guess it really, in many respects, as I said before, it is the way that the percentages that you allocate to those liquid and growth investments, that decision's could certainly be influenced by what your end goals are, and what your outcomes are going to be, depending on what sort of decision. But it's really all about, I think, understanding how all that works and what the impacts are, so that you can make an informed decision in whichever way you go, and you know what could happen.
And I think also, just in addition, is, do you require some additional cash, and if so, when might you actually require that? An example of that could be in 3 years' time, you want to purchase a new car, say you're in retirement, for example, and you may wish to update that again in 7 years' time. So these are the sort of considerations that holistically, we need to ensure your portfolio delivers access for you to those cash reserves to carry out those objectives.
Yeah, and just returning to Chris's question with the children as trustees, Chris, you've also made a comment that the children are also contributing as well. So that brings another complexity and also potential continuity for the fund, albeit assets in the register might need to be looked at as well, Chris. So from John, how long should we keep money in super? How long should we keep money in super? Excellent question. David or Peter?
Yeah, that's an interesting question. I guess I've got to start with where are we today? What age are we? Are we in retirement? Are we not? I think that from the opening gate, I'd need to understand that. At the end of the day, superannuation is a great opportunity to invest for projected return. Like any investment, I think it comes back to, again, understanding what your objectives are financially, and I guess more importantly, when you want to achieve that financial outcome. And I think that then starts determining what kind of investment vehicles you consider based on risk tolerances and returns. And you may find, certainly in Australia, we're very, very fortunate with superannuation and the introduction of that in sort of 87. And it does offer us that investment opportunity of putting money away, also your employee contributions, and I think managed well over a time horizon of your working life, it does contribute significantly to funding retirement. So I think the importance of superannuation, investing in superannuation, how long, all determined by what your objectives are, where you are, i.e. age, and how much you're looking for in retirement to fund your retirement.
Yeah, and certainly, David, anything you'd like to share with that?
No, I'd pretty well agree with I think what Peter said. Really, I wouldn't have perhaps a lot else to add to that.
Certainly, self-employed people. This is not advice, and this is not a piece of advice. But as a self-employed person, I personally have been fairly buoyant on the concept of a self-managed super fund and the ability, from a tax-effective point of view, to be a little bit more aggressive in those earlier years from a pre-retirement planning perspective. But anyway, that's just my view. From Ryan, thinking of creating a legacy, what investment vehicle would you use for grandchildren? Something like insurance bonds or ETFs? And will one of you kindly explain ETFs for our audience as well?
That's you, David.
Well, yeah, an exchange-traded fund is really it trades on the stock exchange like a share, and you buy them like shares. It's actually a trust that holds a sort of a pool of assets. So it could be some shares. Some of the common ETFs that trade on the market would actually look to say replicate the top 200 listed Australian companies would be a common one. So so it would actually be it's what's called a passive investment that looks to replicate the returns of an index. So it's a way of, I guess, it's an easy way of getting a let's say an exposure to a particular sector like the Australian share market in a diversified manner with with one transaction. So it's certainly an option for funding. I guess with that though, if you're going to own the child, of course, wouldn't be able to own an ETF. A minor wouldn't be able to do that. So the investor the adult would own that, and of course, ultimately, if they want to they want to transfer that or give that money to the child when they get of a particular age, then they'd have to sell it and incur capital gains tax. So you've got that sort of issue there as well. In the case of the retirement, the bond, that's a bit of a different structure with that one, where it's the insurance bond type thing, where it's actually a pooled sort of managed investment vehicle. that you'd buy by application, and it's sort of internally taxed at 30%. You don't pay tax at your own rate. So and there can, depending on, there sometimes can be some tax advantages if held for a 10-year period, but you are paying tax as you go along. So I guess it's the answer to that question is, I guess you're looking at returns, but also the personal tax situation of the investor as well. So sometimes it may be better to have something in your own name and then sell it later on and pay some capital gains tax. But other times that may not be the case also. Might be better.
And there's also implications of having a trust as a legacy vehicle too, aren't there? And yes, it could be beneficial, but it needs proper consideration and advice based on circumstances as well. So the nature of the trust too, right?
That's right. So the tax situation there is again different.
One point I'd like to just add on that as well, if you're thinking of creating a legacy, is also coming back to will and estate planning. You know, if the unfortunate occurred and you passed early and the ETFs were in your name, destined for said grandchild, that instrument needs to be in play correctly within your estate planning. So it's a very important factor on it.
Yeah. Interesting question from Axel, and one that we will all be presenting our own personal disclaimers in attempting to respond to, and that is now the time to buy property at 3.5%, for example, at a lending rate on debt, and pocket the 5% rental return, pay the principal after the cost there. So, interesting question. Again, without the ability to fully analyse the client scenario, we wouldn't have direct advice there, Axel. I'm sorry. Peter or David, is now the time to look at property given the debt funding realities?
Yeah, I guess, look, let's not use the word property. Let's just treat it as an investment and a return on that investment, because essentially that's all it is. So if we're looking to access funding and leveraging at 3.5%, and we're obviously looking at some kind of 5% return on that investment, the question probably comes back to what's the timeline in terms of that return coming back to you. I think that's an important piece of the equation to understand. Any other holding costs associated with that particular investment, taxation benefits, are there any other taxation leverages? All of this kind of comes into play. And then, of course, the big decision, why would you want to do that at all? What is the purpose of that consideration? And that really comes back to, again, your financial outcome over a period of time. So I think not understanding that first and foremost, or from my perspective, I'd want to understand that first and foremost, so that any investment strategy, leveraging, return, can then be truly, I guess, understood clearly with regards to your outcome. So I don't know if that necessarily answers your question. I wasn't avoiding it. It was just, I think there's bigger questions to ask first. And then obviously you could go to market and consider a myriad of different investment strategies that may or may not necessarily return similar or greater returns for lesser leveraging opportunities. You may be able to access 2.5%, 3% in other investment opportunities. So again, it's a pretty deep question.
Yeah, absolutely.
I think also the other thing to realise is that obviously the property market's very diverse, so it's a different story depending on the sector and the location and whatever the other characteristics the property has. So that's well beyond any further comment here. But
and the product type too, David.
Yeah, that's right.
Is it a townhouse? Is it a house and land? Is it a unit? They all have different.
I think also talking about investments generally, what we're also finding is with low interest rates and that ability to borrow more money, it has tended to force up asset prices. So whilst interest rates might be low, you probably tend to, in general, paying more for an asset, be it shares, property, or whatever that you may have some years ago. So I think that's for that reason, and we know that the starting price that you buy something for does influence the overall return. But of course, it also becomes a bit less significant with the passage of time. So as Peter said, I think given the unknowns and the fact that rates are low, perhaps prices are a bit high at the moment, time frame is really the key ingredient, the key element. If you have that, you're prepared to commit long term, then you know.
The other point I'd make on that also, David, I quite agree, is your capital appreciation of that asset potentially. So whilst the focus on that question is on the return, the capital appreciation also is a factor in that return. So whilst we're specifically talking about a 5% rental return, the appreciation on that investment over a period of time, I would hazard a guess, would be significantly greater than that 5%. So
yes.
more to consider.
Yeah.
And from Reg as well, why is superannuation often considered to be a good investment as compared to many other forms of investment vehicle?
Taxation environment would probably be my initial opening and response. The opportunities within the superannuation structure to reduce your tax position is second to none, including SMSF as well. So contributions into superannuation, only attract a 15% tax contribution or taxation penalty, if you like, as opposed to your nominal tax rate. So it's a great environment from a tax perspective to invest in. I don't know, David?
Yes, the other thing is that the ultimate goal why people may often look at utilising the superannuation system to a fair extent is that at retirement there are further tax concessions. So it's possible to actually generate a tax-free income, at least under existing rules, if you meet the right criteria, for the rest of your life. There are some limits now on how much you can have in that sort of tax-free environment, but overall, I think compared to the tax concessions that are available to superannuation investors are such that they may not have to even borrow money necessarily and take that additional risk that's associated with leveraging, given the benefit that the tax concessions offer. And quite often we often recommend to people to, if we know what their end goal is, we'd like them to be able to achieve that in the simplest and least risky manner. And that may involve using, say, the superannuation system rather than extensive borrowing, which introduces more risk, if that's possible. Or it may be a combination of both.
Yeah, thanks, David. Thanks, Peter. From Rob, with the projected cost of pandemic and the impact on the economy, does the panel expect a steep rise in federal and state taxes? Interesting question.
I couldn't say no, David. How about you? I'm not going to say yes, but it's a tough one. Do I feel my son's going to be paying for this? Yeah, I kind of figured quite possibly.
Yeah,
we know that government debt has increased dramatically with all the spending that's happening, but I guess it's been necessary in the sort of shorter term to keep things going and avoid a bit of a catastrophe there. So but we've also had some unusual activity with the Reserve Bank, of course, buying some of the government bonds as well to maintain a liquid market. So there's people there to give the government money, and so that they can then use it to spend to keep the economy going. Whether that's probably not sustainable to the same extent in the future, but I guess the whole idea, isn't it, is sort of bridging the gap in the short term, so that without going into excessive debt, so that the economy's got some time to recover and will prosper going forward. And there are a lot of positive aspects to the global economy as well, with a lot of the emerging countries, like India and a lot of the Asian countries, even Brazil and so forth. Some of those people are moving into the middle class areas and consuming more, and that won't stop. people are aspirational. They want to improve their standard of living, and that creates a lot of investment opportunities as well.
Yeah. Just on that.
Sorry, John. The second part of that question, Rob. Just with regards to capital appreciation on investment properties, and do we perhaps have a view on whether that's stalled for the foreseeable future? The recently announced subsidy or grant from the government to encourage, returning to the workforce or keep the builders busy, the population growth. I think by default self-perpetuates the demand for that supply of that particular product. So I'm not convinced that my home would decrease or stall in value. Obviously, it's dependent on perhaps where you live or where a particular investment property may be. Certainly, it's a consideration. But I think nationally, the likes of Sydney, Melbourne, Brisbane, WA, your major sort of metropolitan cities, I don't really see that's going to impact or stall in the foreseeable future. Keep in mind that property is very much a long-term investment. It's not a 3 or 5 year return on investment. You're talking 15, 20 years, so you need to perhaps just consider the time horizon on that. And that's how I view it. It's a very much a long-term proposition.
Yeah, and one thing for us that don't want to be overwhelmed with doom and gloom to remember is that the government's also accessing money at an incredible marginal rate as well. So, as some economists have reported, so there's a unique opportunity for the government to ride this one out too, right? Which is something we often forget. Okay, thank you so much for everybody and all the Q&A that's been coming through tonight. That's terrific. We've come to the end of the presentation tonight, and don't forget, we'll drop that contact form back in. We will send it via email as well, but I'll get Emily to drop it back into so it's top of mind. Thanks, Emily. Well done. You're very welcome, John, and thank you, Rob and Sue and Jen and all the contributors, Reg, for your questions tonight. It's been really appreciated. Christopher as well. Lovely to see you again. I bet you Mildura's a little warmer during the day than good old Melbourne at the moment, Chris. Thanks, Peter and Marissa as well, and Joel. So a big thank you to TFLG and, of course, Peter and David. Thank you very much. Golf clap for the gentlemen. And we look forward to arranging those complimentary consults about your own unique circumstances and aspirations and objectives. And Grant, you're very welcome. And
also, John, thanks very much for your support in hosting this and putting it together. It's been fun.
Yeah, you're very welcome. It's lovely to see you all, and stay safe, stay optimistic, and stay focused. That's the key.
Stay Queensland.
All right. See you later.
Bye, everyone.
Bye.